Market Maker Model Simplified. Now, this was a mentorship exclusive, but because I like y'all, I'm gonna drop it for free. Now, there's a huge misconception going on in trading. A model is way more than just a pattern and some time frame alignment. For example, if Michael Jordan or Kobe Bryant taught you the foundations of shooting a three-pointer, are you going to be able to replicate it in a real NBA match? It's the same for trading. If I give you the foundation for something, does not mean that you're going to be able to execute it at the same level as me in the real markets. Now, those experiences can be built up, and the mentorship helps with that in a packaged, simple solution. And that is why I'm able to provide such foundational videos for free. Because I had someone ask me, if you provide all this stuff for free, then what's in the mentorship? Well, I just answered that. I don't want to hold y'all because I know this video will elevate your trading to the next level. So y'all better pay attention. Peace. Yo, welcome to this beautiful lecture on market maker models, because that is, bro, the market runs on market maker models. If you watch my videos, if you saw me talking about market maker models or tweeting about it, y'all already know. It's basically all we trade, in my opinion. I don't care what anybody else thinks, but this got me profitability. So thank you to ICT for putting it into language that I can understand and I can teach y'all. So as I said, guys, let's think this is the daily or the H4. It doesn't matter. This is just a higher time frame. This is all fractal. It works on any time frame, but the higher time frame holds more weight. Why? Because that's where the institutions are operating from. We know that the market runs from internal range liquidity to external range liquidity, and we want to get a little pie, ideally, these two trades. We don't want to call tops, but you can. But ideally, you follow and you want to take these trades right here because those are the higher probability ones. And when I see those trades, I go big risk. Oh, my funded challenges. Obviously not on live. On live, like, I want to keep my accounts alive as long as possible. So I'm not risking big on there. Even if it's a high probability trade. And even if I don't even trade counter trend on those accounts. I just trade usually these setups. Or maybe even this one if my bias is extremely strong. Alright, so let's get straight into it. Let's see. In the market outlooks, I always tell y'all Monday is usually the accumulation or the consolidation for the power of 3. What is the power of 3? Long story short, the power of 3 is, and put this like this. If this is the candle and we are bullish or bearish, I don't care. Let's just say price opens up here. We accumulate orders, we manipulate, and then we displace down, right? That is power of 3. Every candle, obviously they're not going to look that beautiful, but that logic, you need to have it in your mind. AMD, accumulation, manipulation, distribution. We want to trade after the manipulation occurs. Why? Because that's the highest probability, because the distribution lags are the biggest. Mostly, in my experience. So, when we accumulate, what do I want to see? I want to see a clear sweep into a change in the state of delivery, indicating we are retracing. Do you guys understand it now? Because I got a lot of questions. This is when you should start to look for counter trend trades. And even if this is your higher probability counter trend trade and this one, you don't want to catch bottoms. You want to let the market tip its hand to you. And then once you see this price lag, retrace into discount with a sweep. It doesn't need to sweep. If it sweeps, it's higher probability, but it does not have to happen. Everything I'm teaching right here, it doesn't need to be perfect. You need to know that the logic of price is internal range liquidity to external range liquidity. It's not always going to look beautifully like this. It's not always going to even look beautiful. Maybe we're going to just do this and then boom, you missed a move. Do you care? No, because there's endless opportunities in the market. We don't care. We place ourselves into the less riskiest possible scenarios where we have the best reward, because we have an edge and we don't want to push our edge until it's dull. We want to cut it, put the knife away, sharpen it, cut it, but not cut. That's how you dull your knife. Capiche? You want to trade the highest probability setups, which are these two. And I will get straight to it after I explain this, because this one is key to understand. You don't want to trade this. This is usually a consolidation into expansion, or maybe manipulation, expansion. I don't care, whatever it is, but I don't trade this. I don't know the details of it. But once we are out of this range, we leave a fair value gap. And I see this pattern. Okay, I might take this trade. And let me clarify, you don't just set your limit here. You wait for extra confirmation on like the M5, M15, I don't know, whatever you want to use. But inside of these places, and ideally, I'm going to ignore this one, but inside of here, you want to see another breaker pattern. Capiche? Oh, that is the wrong side. Like this. Inside of here. And then you target whatever you want to target. Alright, so I hope that is clear. And then, because we are in discount, right? So you can long, but it is lower probability because we don't know. These can just be consolidations into expansion. We don't know. That's why you don't want to trade them. Just until you're profitable, ignore these. Ignore the retracements, please. Trust me, I talk from experience. And also, these sides, this side of the curve is usually engineered low resistance liquidity run for when we get this to this side, and then it's gonna melt. So you want to chill here. You don't want to trade this low resistance liquidity run generating lag. You want to trade this lag where we cut through it like butter, like ICT says. Okay. So right here, when we reach the premium array, we wait for either a H1 or a H4 change in the state of delivery. How do I internalize change in the state of delivery? If there's a lag, the last lag, that may be rebalanced a fair value gap, but the last range low. When we displace through it, that is my change in the state of delivery. That is how I internalize it. I don't care how somebody else does it. If you don't like the term, use something else, but that's how I use it. All right, so you don't want to catch tops. This right here might look nice, like a beautiful unicorn. And then you try to catch the unicorn right here. You see a beautiful unicorn. It looks so obvious. What happens? It comes back up and you got a new unicorn right here at the top. And then you're going to cry that you have no equity left. You risked 1%. And now you're like, I don't know, but I just got wrecked. What if I get wrecked again? Should I trade? Should I not trade? Trading is fake. Trading is a scam. Me. That is why you don't trade tops or bottoms. You wait for the market to tip its hand on the H4, on the H1, or on whatever time frame you prefer. You generate your own model with this logic. You need to use this logic though. If you want to trade like me, you need to use this logic. This is how I internalize price. So once we are in the premium array, you can have SMT with correlated pairs. What does that mean? One pair sweeps and the other pair doesn't. Maybe another pair sweeps again and this one doesn't. That is SMT, stuff like that. So that's extra confirmation. If you are not advanced, don't bother. So once we get this change in the state of delivery, this is your low risk sell. Right here, you look for a unicorn. Right here. Right here. Okay, right here you look for the unicorn. Not on this top, but right here. After you get confirmation. And then once price melts, this is extra confirmation. Extra. And I purposely drew this like a seek and destroy profile. And these lows right here, that I mark right here, let's say these are not candle closes. So our range would then be this high to this low. Okay? And that's why you need to properly use ranges. So right here, after we have a confirmation that we are heading for this external range liquidity right here, that is when you can be a bit more aggressive. And if you want, you can trade this turtle soup. That is a turtle soup. This is also a turtle soup, but it's riskier. Why? Because you're catching a top. Now we have the top, but we are catching a little top. We are not catching the top of everything. We are catching the top when we already know price is probably heading towards here. So the probabilities of it actually being a turtle soup that's going to hold is higher than this one. Why? Because we have this confirmation. Okay, it's that easy. So when we have this confirmation, you look for another breaker pattern or whatever you want. But I use the breaker pattern, and then you target. What do you target? External range liquidity. Yes, you're starting to get it. Good job. Let me take a sip of my drink, bro. Okay. So the best trades, the most explosive trades happen when you stop people out. Capiche? Those are when the best trades happen. So let's say this seek and destroy profile. There might have been a beautiful unicorn and you might have catch a move targeting this. You can do that. It is probabilities in this game. If we are in premium, if we sweep something, if we are in a fair value gap, you take the risk if you want and you journal and you see, okay, I notice when we are at this last leg, when we are going to discount, those are the most explosive moves. So let me just trade those. You can. I don't care. You can trade whatever you want, but you need to understand the logic, premium and discount. Like right here, this leg, and then we have this, right? Now we're going to have an inception. We're going to fractalize it. Now let's imagine this leg that we put it in here. Can I actually do that? Can I do that? Can I make this smaller? No, I can't. Because as you guys know, this leg right here is also just a leg that goes like this. So this is this. Wait, let me check. So break this. This is the high, low, high. So this leg is also like this. You see that? And then inside of that are probably 1 minute market maker models or lower time frame. Do you understand? So, and then inside of this, we will have a unicorn pattern. And then again, we have another range. And there's probably a market maker model inside of there as well. Do you understand? There's a market maker model everywhere, but you pick the highest probability ones. Capiche? Why do you pick the highest probability ones? Because we don't want to lose demo money. You don't want to trade every move. You just trade the higher probability ones. And which one is higher probability? This, option number 1, or this, option number 2? If you had to choose between these two, I will give you 5 seconds. 1, 2, 3, 4, 5. It is option number 2. Why? Because we have extra confirmation. Okay? You want to trade the extra confirmation trades. It's that easy. Then we melt down again. Oh, guys, listen. There can be SMT right here as well. It's not going to look this beautiful every time. We might miss some moves. Sometimes this might consolidate and just melt without you with news. It doesn't matter. What matters is that you manage risk, and whenever it happens, that you are behind the chart, ready to execute. That's why you don't push your edge when you don't see the model appearing. Why? Because you're just going to waste your mental capital. You're going to waste your equity. And then what's going to happen? You're going to cry. You're going to be scared to execute when the real move happens. Okay. So what do we do? Like, do I even need to explain it? Like, I wanted to explain this one too. But, okay, so what do we do? Let me explain the last one too. After we break the leg, we look for ranges. After we see our ranges, let's say this high, low, high, low. Okay. I put this example purposely. So obviously, this is a range, right? and the price has not yet touched discount, but it has rebalanced a fair value gap. Those might be traps, or those might be SMT with another pair, but that is why when you trade the breaker pattern, it is higher probability in my opinion. So you can trade, like when you see this happening, this fake high that looks clean, that looks like an internal to external, and then it gets swept, and then you have a real move with a real unicorn. Okay? And I love these trades, by the way, because we have this confirmation, we are close to the discount array, and then we have another sweep of a high. I'm like, damn, let me short right now. Now I'm trolling. But that's how you, by the way, this market structure, this is how you can catch soups. Okay? But no, don't catch soups. Just learn this first. No, I'm getting too excited because that's, when you learn that, it's a different game, because then you can scale pyramid and stuff, but that's hard. That's not easy. Well, it is easy. You just need patience and you need to understand higher time frame narrative. Okay. So, soup, unicorn, and then what is our highest probability trade? This one right here. And this might not even retrace, it might just reprice immediately. But if it retraces, you already know. Unicorn, limit, target. Oh, external range liquidity. Easy. Oh, by the way, when I say target external range liquidity, I don't mean you target it and you put your TP there. I mean you take a small piece of the pie right here, but your target is this. You don't need the whole TP. 2RR is all you need. Maybe even less. Just, this is why data collection is important, because you will know your minimum RR. And if you know your trades are running for minimum, let's say 1.7 RR, are you going to get scared in between, like when the unicorn happens and then we retrace? Are you going to be scared when price does stuff like this? No, because you know the odds of it hitting your TP. So you're going to be like, okay, let me open up my journal. Let me read through my journal. Okay, my trades usually hit 1.7 RR. If I close right here, I'm just dumb. So you don't close. Easy as. All right. Easy as. Look at this art. This is just art. Let me see if I forgot something. Not much. But I want to say something though. Don't expect price to be perfect like this. Maybe it's gonna have a smart money reversal where it doesn't let you come back to the breaker. Are you gonna cry? No, because there's more opportunities on the way down. We don't chase price. We let price come to us. When you chase a cat, it runs from you. When you chase money, it's the same. When you chase price, it's even worse, because you're gonna chase price. You're gonna chase price like the unicorn. Wait, like this. Wait, let me draw it properly. So we have a unicorn here, and then you think, okay, it's not gonna come back. And then you see another leg. You're gonna enter here, put your stop here, and then boom, it comes back to the breaker. Boom, you're out of the trade, and you see it running to your take profit, and you're gonna be like, oh, trading is a scam. Trading is a scam. Nah, trading is not a scam. You just are impatient and in love with money. You put money on a pedestal. You don't get something you put on a pedestal. Well, maybe you get it, but you get my point. So, left side of the curve is usually a low resistance liquidity run generated lag. So don't expect these beautiful unicorns to happen. But if they happen, you might want to, like, I suggest you don't trade retracements. But hey, if you want to do it, be my guest. Like, as much as I said, you need to burn yourself before you understand what I say. And then you're going to think back of these lectures and you're going to be like, damn, he told me, it was right in front of my eyes, yet I burned myself. This is a beautiful trade, and this is your highest probability one. And this is also ICT's favorite trade, the second stage of distribution. And let me drop another gem. When we have this range, right? This range right here. When we are below the 50% mark, this trade is higher probability. Go to my YouTube, watch my first ever video. That's where I explain it. if you want to learn more about it. Yeah, that's it, boys. I hope this lecture actually helped you guys a lot. I don't have much more to add. And if I want to do more advanced lectures, I might, but I don't want to overcomplicate it, because if you overcomplicate it, you are just going to delay your progress. This is all you need to know. Unicorn, premium to discount, and every time you have new ranges, you wait for price to tap in premium, you wait for a unicorn, you follow the wave. You don't trade this, you trade this, down, down. You trade the price with the current. When you're swimming, are you going to swim against the current? Nah, G, you're going to swim with the current, so you're fast, you're chilling. All right, boys, that's it. Peace.